Most traders will never catch a single 110 trade in their entire career, not because the market doesn't offer them. The market throws these opportunities at you constantly. Every month, there's a stock, currency, or commodity beginning a journey from quiet consolidation to explosive trend. The real reason is harsher and more personal. The moment you see green on your screen, your biology betrays you. You panic into profit. You grab the 1-1 and watch the market run to 110 without you. Here's the brutal truth that separates retail traders from legends. Amateurs are obsessed with being right. Professionals are obsessed with being big when they're right. That distinction sounds subtle, but it's the difference between a lifetime of break-even trading and generational wealth. You've lived this nightmare because every trader has. Let me walk you through the anatomy of this failure. You buy a breakout at $50. Clean pattern, good volume, everything aligns perfectly. You place your stop at $48. You're risking $2 per share. The stock moves to $55 in 2 days. You're up 10%. On a $5,000 position, you're looking at $500 of open profit. The voice in your head starts screaming. Take it. Don't let this winner turn into a loser. You know what happened last time. Your heart beats faster. You flip between time frames looking for exit signals. You move your cursor to the close button 3 times. Finally, you click. You sell at $55. Relief washes over you. You feel smart, even proud. I locked in the profit. I did the responsible thing. 3 weeks later, that same stock trades at $80. That's a 60% move from your entry. A 115R multiple if your stop was $2 away. You didn't miss that move because you couldn't find it. You missed it because your psychology wouldn't allow you to sit through it. You traded your fear instead of the trend. Now ask yourself, how many times have you repeated that exact script this year? Different ticker, different numbers, same devastating movie. This is the core identity problem. The amateur's brain is wired for short-term validation. They need to lock in small profits to feel intelligent. They treat every trade like their last opportunity. They stare at their P&L and trade that number instead of trading the actual trend. When they see green, their brain screams protect. When they see red, their brain whispers hope. This emotional wiring guarantees they'll never catch a 110 trade. The professional's identity operates on completely different principles. They expect 6 or 7 small losses for one monster win. That's not a bad month. That's just the mathematics of trend following. They treat risk like rent, the cost of staying in the game. They treat strong trends like ownership. When they have position aligned with the tape, they think in weeks and months, not minutes and hours. Here's a revealing comparison. 2 traders start the year with $20,000 each. They both take 40 trades. The amateur wins 60% of them, with an average 1.1 reward to risk. Lots of winners, lots of validation, lots of screenshots for social media. After commissions and slippage, he's up maybe 3 to 5%. Often flat, or slightly red. The professional wins only 30% of trades. Most are small scratches or clean 1R losses. Emotionally, that feels like constant failure if you think like an amateur, but his winners average 115, and several times yearly he catches 1,008 or 110 moves. At year's end, he's not up 3%. He might be up 40, 60, even 100%. Same market. Different identity. Completely different outcome. Jesse Livermore understood this long before modern psychology explained it. He didn't get rich calling every top and bottom. He got rich doing what your brain hates, sitting still when he was right. There's a famous story about an old trader called Old Turkey who would hold positions through entire bull markets. Young traders would urge him to sell and buy back lower. His response was legendary, "It's a bull market, you know. If I sold now, I'd lose my position. Then where would I be?" Old Turkey understood that his position, his entry price, his foothold in the trend, was his most valuable asset. If he sold to be clever, he might never get back in. He might miss the real move while trying to capture noise. Livermore learned from this wisdom. He said, "It was never my thinking that made the big money for me. It was always my sitting. But sitting is the hardest work you'll ever do in trading. It doesn't feel like work. It feels like dangerous inaction. Your brain interprets stillness as threat. When you're holding a winner and it pulls back 2%, every instinct screams for action. Tighten stops. Take partials. Do something. But in trading, disciplined stillness is often the highest form of skill. Here's what most traders never grasp. The market doesn't care about your comfort level. It doesn't care that holding through pullbacks makes you nauseous. It trends at its own pace. If you can't emotionally survive normal volatility inside a trend, you'll never capture the abnormal profits at the trend's end. Your inability to sit still costs you millions over a career. The deepest contradiction in trading, the skill that feels safest short-term, taking quick profits, is exactly what keeps you small long-term. And the skill that feels most dangerous, holding while unrealized profits swing around, is the habit that builds real wealth. In this series, we're dissecting the exact protocol professionals use to turn good trades into career-changing trades. You'll see why your current risk structure makes 110 mathematically impossible, how they size positions to emotionally survive the ride, how they use pivotal points to let winners run while cutting losers fast, why waiting is the most active position you can take. Before we build that system, you must accept this uncomfortable truth. Your psychology is currently your enemy. Not the market, not algorithms, not news. You. If your rules guarantee you'll bail at Welve 2, then a 110 trend could unfold perfectly, and you still wouldn't ride it. Your system must be built for psychological reality, not fantasy. The foundation isn't sexy or exciting, but it's the difference between trading for 20 years versus blowing up in 20 months. In our next chapter, we'll design the risk engine that makes everything else possible. Until then, ask yourself, are your current habits designed to catch big trends or kill them the moment they start working? You don't find 110 trades wandering through the market like lost treasure. You build a risk structure robust enough to survive long enough to catch them. This is the unglamorous reality that eliminates 90% of traders before they even understand the game. They think finding the setup is the challenge. It isn't. Surviving until the setup pays off is the challenge. Here's the first hard rule that will determine whether you ever see a 110 trade. If losing, 1R feels like a life or death event, you will never see. 10R. It's psychologically impossible. If your heart races when a stop-loss triggers, you're already defeated. You cannot hold a winner if you cannot stomach a loser. The mathematics of big trends demand that you endure periods of drought. If your emotional tank is empty before you cross the desert, you die of thirst watching the oasis. Let me show you two traders with identical starting capital. Both have 50,000 in their accounts. Both are hunting the same setups. Both believe they understand risk management. But their outcomes will be completely different, because one understands the mathematics of psychological survival and the other doesn't. The amateur decides he wants to grow his account aggressively. He risks $2,500 per trade. That's 5% of his equity. In his mind, this feels reasonable. He's read about traders who risk 2%, others who risk 3%, so 5% seems bold, but not reckless. He takes his first trade according to his system. Clean setup, good entry, proper stop placement. The trade fails. He's down 2,500. His account reads 47,500, annoying but manageable. Second trade fails. Account drops to 45,000. Third trade fails. He's at 42,500. Fourth trade fails. His equity now sits at 40,000. In 4 trades, he's lost 20% of his capital. But here's what really changed. His psychology is shattered. Every new setup he analyzes now triggers a cascade of fear. What if this is another loser? I can't afford another. 2,500 hit. Maybe I should skip this one. Maybe I should wait for a better setup. He's paralyzed. Every entry feels like Russian roulette. He starts second-guessing his system, reducing size out of fear, or stopping trading entirely to preserve capital. The brutal irony, his risk structure has destroyed his ability to execute precisely when he needs it most. He's not out of money. He's out of confidence. Now consider the professional with the same 50,000 account. He risks 500 per trade. That's 1%. His first trade fails. Account drops to 49,500. Annoying, sure. Devastating, Not even close. Second trade fails. He's at 49,000. Third, fourth, fifth trades all fail according to his system. Normal variance in a trend-following approach. He's now at 47,500 after 5 consecutive losses. He's down 5%. His confidence remains intact. He's irritated but not emotionally damaged. Sixth trade fails. Seventh trade fails. After 7 consecutive losses, his account sits at 46,500. He's down 7%. Here's the critical difference. He's still executing without hesitation. His hand isn't shaking when he clicks the entry button. He's not skipping setups because he's terrified. His risk structure has kept him in the game psychologically. This is where most traders miss the deepest truth about position sizing. You're not sizing for the trade you're taking. You're sizing for the losing streak you can't see coming. The 110 trade doesn't announce itself with fireworks. It doesn't send you an email saying, "Hey, I'm the monster winner. Risk more on me." It looks exactly like the 7 losing trades that preceded it. Here's the paradox that destroys careers. Big R multiples only show up after strings of small, boring losses. The market doesn't reward you in a predictable, linear sequence. It tortures you with losses, then suddenly gifts you a monster winner. This isn't cruelty, it's mathematics. Trends develop after failed attempts. Breakouts succeed after false starts. The 110 trade is usually hiding at the end of a losing streak, rewarding the survivor. Jesse Livermore understood this viscerally. He talked about fighting on the right side of the market. But you can't fight on the right side if you've already blown up your army in the first few battles. You need soldiers left standing when the decisive moment arrives. Small position size is how you keep your army intact through the early skirmishes. Let me walk you through a scenario that plays out in thousands of accounts every month. A talented trader decides to hunt. 110 moves. He studied the masters. He understands trend following. He chooses to risk 3% per trade because he wants to make meaningful money when he's right. That logic sounds reasonable until you watch the mathematics unfold. First trade, clean breakout, perfect setup, fails immediately on a false signal. Down 3%. Second trade, another promising start that reverses against him. Down 6%. Third trade, stopped out on a normal retest that he couldn't emotionally handle. Down 9%. Fourth trade, the trend shifts and catches him wrong-footed. Down 12%. Fifth trade, another textbook setup that simply doesn't work. Down 15%. He's now staring at a 15% drawdown after 5 trades. His stomach churns. He's questioning everything. Did he pick the wrong strategy? Is the market different now? Should he take a break? His confidence is in ruins. Then the 6th setup appears. It's textbook perfect. A clean breakout with volume confirmation, tight consolidation, clear trend structure, everything the professionals teach. This is the trade he's been waiting for. But he's emotionally destroyed. He has 2 choices, both bad. Skip the trade entirely because he can't handle another loss. Or size down dramatically too. 0.5% because his confidence is shattered. Let's say he takes the trade at the reduced size. The trade runs beautifully. It goes 1.8 without looking back. Here's the devastating mathematics. At his original 3% risk, that 1T8 winner would have generated a 24% account gain, enough to erase his entire losing streak and put him significantly ahead. Instead, at 0.5% risk, he makes 4%. He gains 2,000 when he should have made 12,000. His risk structure cost him 10,000 on the one trade that actually worked. He caught the right move, but couldn't capitalize because his position size was psychologically damaged. This is how traders spend years in the market without building real wealth. They identify the correct trends, but can't bet size when it matters most. Their risk engine fails at the moment of truth. The protocol for hunting. 110 trades requires mathematical precision and psychological honesty. First, risk, 0.52. 1% of equity per trade. No exceptions. This sounds conservative to the amateur dreaming of quick riches, but it's the only structure that survives the mathematics of trend following. At 1% risk, You can lose 10 consecutive trades and retain 90% of your capital. You're still in the fight. 7 consecutive losses don't change your lifestyle, your sleep, or your ability to execute the next trade. Second, define your R before entry. Entry price minus stop-loss price equals 1 R. That distance is your unit of risk. Once you enter the trade, consider that money spent. It's the cost of doing business, like rent or insurance. Your only job is to risk it cleanly. If the trade works, you get it back with interest. If it doesn't, you paid your tuition. Third, track R multiples, not dollar amounts. Dollars are emotional. Dollars represent rent payments and car notes. R multiples are objective. A, 100 loss, and A, 1,000 loss are identical if they're both 1 R. When you think in multiples instead of money, you gain a superpower emotional detachment. You stop seeing 5,000 profit as a vacation fund and start seeing it as 5 R. This detachment allows you to hold 10 R while the amateur panic sells at 2 R. Fourth, normalize losing streaks in your mental framework. If you're hunting big trends, you will miss frequently. Expect clusters of 5 to 8 losses as the admission price for one exceptional winner. Don't view them as failures. View them as necessary tuition. They're the cost of staying in the game long enough to catch the trade that changes everything. Here's the counterintuitive truth that takes years to accept. The smaller your risk per trade, the larger the trend you can mentally sit through. When you're risking 1%, A. 30% swing in your unrealized profits doesn't destroy your sleep. When you're risking 5%, that same swing makes you nauseous and forces early exits. Position size isn't just about capital preservation. It's about giving yourself permission to ride the trends that actually pay. You're building a machine designed to eat small losses so it can feast on big trends. The risk engine is the heart of that machine. Without it, your strategy becomes gambling with better charts. The professional understands that survival comes first, profits come second. The amateur reverses that priority and wonders why he never builds lasting wealth. In our next chapter, we'll explore how professionals use pivotal points to define exactly where they're wrong. This precision allows tight stops, clean 1 R definitions, and the asymmetric trades where 1 R of risk becomes 5 R, 8 R, or 10 R of reward. Because knowing where to exit is infinitely more important than knowing where to enter. Risk management without precision is just sophisticated gambling. Most traders think 110 trades start with perfect entries. They obsess over the exact moment to pull the trigger, studying candlestick patterns and indicator alignments, believing that perfect timing creates perfect profits. But professionals know something that changes everything. 110 trades don't start with perfect entries. They start with perfect exit points. Your stop loss isn't just protection against catastrophic loss. It's the mathematical definition of your entire hypothesis. Entry to stop equals your bet. Price behavior around that level equals the market's verdict on whether you're right or wrong. This distinction sounds subtle, but it's the difference between catching trends and watching them pass by. When you define your exit first, you're thinking like a scientist testing a hypothesis. When you focus only on entry, you're thinking like a gambler hoping for luck. The professional asks, at what specific price is my idea proven wrong? The amateur asks, how much am I willing to lose? Those are completely different questions leading to completely different outcomes. Here's where amateurs systematically destroy their own potential. They place stops where it feels safe, not where their idea is actually invalidated. Let me show you this failure in real time. A trader sees a stock breaking out at $52. Clean pattern, good volume, everything looks textbook perfect. He decides to buy. Then comes the critical moment that will determine whether he catches a monster winner or gets shaken out before the real move begins. The amateur thinks, I don't want to lose too much on this trade. I'll put my stop at $50 because that's what I'm willing to lose. It's a nice round number, and $2 per share feels reasonable. He clicks the order. He's now long at 52 with a stop at 50. Notice what just happened. He didn't look at the chart structure. He didn't identify where the breakout would actually fail. He didn't ask where sellers would regain control. He worked backward from a dollar amount he felt comfortable losing. His stop placement has nothing to do with market reality. It's pure emotional mathematics. 2 days later, the stock dips to $49.90 on what should have been a normal retest of the breakout level. His stop triggers at 50. He's out with a clean 1R loss. He followed his risk management rules perfectly. He feels disciplined, even proud. I stuck to my plan, he tells himself. Then, over the next 3 weeks, that stock rips to $75 without ever looking back. He missed a 111.5 move because his stop was placed where it felt comfortable, not where it was correct. The professional approaches the identical setup with a completely different framework. He sees the breakout at 52. Before he even considers position size, he studies the tape. He zooms out and identifies the pivotal point, the specific level where, if broken, the trend thesis dies. He sees that 51.50 was the previous resistance that should now act as support. That's the critical structure. If price breaks below 51.50 with conviction, sellers have regained control and the breakout thesis is invalidated. He places his stop at 51.40, just below that pivotal point, not because it feels good, but because that's where he's mathematically wrong. The distance from his 52 entry to his 51.40 stop is 60 cents. That's his 1R. Now he sizes his position so that 60 cents equals exactly his predetermined risk amount. If he's risking $300, he buys 500 shares. When the stock dips to $49.90, his stop never triggers. Why? Because his stop was placed at the correct structural level, not an arbitrary comfort zone. The stock retests, finds support at 51.60, and launches to 75. He rides the entire $23 move because his stop placement was based on market structure, not feelings. His 60-cent risk became a $23 winner, a 138R multiple. The amateur's arbitrary stop cost him one of the best trades of the year. This precision matters more than most traders realize. Let me show you the mathematics in another market. Euro USD breaks above major resistance at 1.1200 on massive volume. 2 traders see the same opportunity. The amateur enters long at 1.1205 and places his stop at 1.1150 because 55 pips feels like a normal Forex stop. He's read that professional traders use 50 pip stops, so he goes slightly wider to be safe. The professional looks at the same chart and asks the crucial question, where would this breakout be proven false? He studies the structure and sees that 1.18 is the critical level. If price drops back below 1.18, it means the breakout failed and sellers are back in control. The entire thesis would be invalidated. He places his stop at 1.1175, just below that pivotal point. His entry is 1.105, his stop is 1.1175, so his risk is 30 pips. Over the next 2 weeks, USD trends cleanly to 1.100. That's a 295 pip move from the entry. Both traders caught the trend, but their outcomes are drastically different. The professionals' 30 pip risk became a 295 pip winner, nearly 110. The amateurs' 55 pip risk became a 295 pip winner, about 1005.4. Same trade, same timing, but the professional's precise stop placement nearly doubled his R multiple. Over a career, this difference compounds into millions of dollars. Now here's the deeper insight that Jesse Livermore understood intuitively. Once the pivotal point holds, waiting becomes a position. This sounds mystical, but it's purely mechanical. When you enter near a critical level, and that level holds under pressure, you've gained valuable information. The market is telling you that your thesis might be correct. At that moment, your job isn't to do more. Your job is to observe and let the trend develop. Livermore would enter near these pivotal points, and then simply watch. If price hovered and churned near his entry, that was information. Non-movement near a pivotal point meant the market was undecided, bulls and bears locked in combat with no clear winner. But if price rejected the pivotal point strongly and moved away cleanly with expanding volume, That was confirmation. The market was voting in his favor with real money. This observation phase is where most traders destroy themselves through overactivity. They see a small profit and immediately want to lock it in. They see a small pullback and panic into tightening their stop. They can't sit still while the market makes up its mind. But professionals understand that the first 2R of movement is sacred territory. You don't interfere. You don't optimize. You let the trade breathe and show you its character. The protocol for executing this professionally requires discipline at every step. First, enter near a pivotal point that aligns with the dominant trend direction. If you're buying a breakout, the pivotal point is the breakout level that must hold. If you're buying a pullback in an uptrend, the pivotal point is the swing low that defines the healthy retracement. The key is that your entry is close enough to the pivotal point that your stop distance is logical, not enormous. Second, place a hard stop just beyond that pivotal point. Not a mental stop that you'll watch carefully. Not a stop you'll move if price gets close. A hard stop in the market that will execute without emotion or negotiation. If that line breaks, your idea is wrong, and your job is to be out immediately. The worst traders treat stops like suggestions. The best traders treat stops like fire doors. Once they close, that room is sealed. Third, for the first 2R of movement in your favor, do almost nothing. This is the hands-off zone where amateurs interfere the most. They move to break even at plus 0.5R to be safe. They take partial profits at plus 1R to guarantee a winner. They tighten stops after the first minor pullback. All of this comes from fear, not from reading the tape. Professionals give the trade room to breathe during this critical validation phase. During these early stages, your primary job is observation. Ask 2 critical questions. Does price reject your stop area strongly when it tests it? And once it moves away, does it travel cleanly with impulsive moves and orderly pullbacks, or does it chop sideways with no real progress? Strong rejection combined with clean movement suggests genuine trend energy. Choppy, overlapping price action with endless retests suggests hesitation and dramatically lowers the odds of a smooth 10R move. Here's the harsh filter that separates amateur hope from professional probability, if a trade cannot produce. 2R without drama, the chance of it producing. 10R without torturing you is very small. You're not looking for perfect smoothness. Markets rarely offer that. But you are looking for a specific character, the trend that refuses to revisit your pivotal point. The market that tests your line once, maybe twice, and then leaves it behind as if it no longer exists. This creates a psychological contract between you and the market. You're saying, I will participate as long as you respect this boundary. Violate it with conviction, and I'm gone immediately. Respect it consistently, and I'll give you all the room you need to develop into something special. This mindset keeps you from overtrading every minor fluctuation, and lets you focus on the one question that actually matters. Is my structural thesis still valid? When you start thinking this way, you stop obsessing over shaving a few cents off your entry price. You stop trying to time every minor swing. You trade less frequently, but you trade from conviction. You know exactly why you're in, exactly where you're wrong, and exactly what has to happen for you to stay. Most importantly, you stop getting shaken out of good trades by normal market volatility. Pivotal points aren't just chart levels. They're the foundation of asymmetric risk-taking. They allow you to risk small amounts on structurally sound ideas, while giving those ideas room to develop into career-changing winners. The amateur risks: 1 to make, 1 with arbitrary stops. The professional risks: 1 to make, 10 with structural precision. In our next chapter, we're going to assume something rare and powerful has occurred. Your trade is working. You've entered near a pivotal point. Your stop has held through normal retests, and price has moved. 2R then. 3R then. 5R in your favor. Now comes the ultimate test of professional discipline. How do you ride that winner from 5R to 10R without letting your own psychology sabotage the result? Because catching the move is one challenge. Sitting through it while unrealized profits swing wildly is an entirely different skill, and it's where most traders fail just when success is within reach. Your trade is up. 2R. You risked $500 and you're now sitting on $1,000 of open profit. This is the moment that separates amateurs from professionals more decisively than any indicator, pattern, or system ever will. This is where trading careers diverge permanently. At 2R. Amateurs cash out and feel smart. Professionals lean in and prepare for wealth. You must burn this truth into your mind. The first 2R of any winning trade exists only to pay for your previous losses. It is the next 8R that pays for your career. Most traders murder their 110 trades right here at the 1.2 mark because they fundamentally misunderstand what profits represent. They treat profits as something fragile that must be protected, locked away, secured before the market can steal them back. But professionals see profits as something robust that must be grown, nurtured, and ridden until the market explicitly signals the opportunity is exhausted. This isn't recklessness disguised as patience. This is the mathematical difference between trading for validation and trading for generational wealth. You've been brainwashed by one of the most expensive half-truths in finance. You can't go broke taking profits. That sounds conservative and wise. It feels responsible. But here's what that advice actually creates. A trader who spends decades taking small profits while systematically missing every trade that could have changed their life. You absolutely can go broke taking small profits if those profits prevent you from ever catching the moves that matter. A career of 1,002 winners mixed with 1-on-1 losers after commissions and slippage leaves you treading water for 20 years instead of building lasting wealth. Let me walk you through the anatomy of this failure because you've lived it in different markets with different numbers, but always the same devastating outcome. You identify a weak stock in a clear downtrend trading at $60. The chart shows textbook distribution, lower highs, lower lows, volume expanding on every decline. You short at 60 with your stop at 62. That's $2 of risk per share, your 1R. Clean thesis, this stock is broken and heading significantly lower. 2 weeks pass, the stock grinds down methodically to $56. You're up $4 per share. That's exactly 2R of profit. If you're risking your standard $500, you're sitting on 1,000 of unrealized gain. Your brain starts its familiar whisper campaign. This could reverse. You've seen winners turn into losers before. What if it bounces and you give all this back? That would be devastating. You should protect this. Fear creeps in through the back door dressed as prudence. You decide to trail your stop from 62 down to 58 to lock in profit. In your mind, this is sophisticated risk management. You're guaranteeing that even if the trade reverses, you'll still capture 1R of profit. You feel clever, disciplined, responsible. You modify the order. Your new stop sits at 58. The next day brings a perfectly normal counter-trend bounce. Shorts take profits, bargain hunters nibble, and price lifts too. 57.50 on modest volume. Nothing about the big picture has changed. The downtrend remains intact. But your stop now sits directly in the path of routine market noise. Price tags. 57.50, your stop triggers and you're ejected from the position with 1.25R profit. You made $625. You tell yourself you did the right thing, you were disciplined. You protected your winner. Then the real liquidation begins. Over the following month, that stock collapses to $35. The move you correctly identified, the breakdown you were absolutely right about, delivered a $25 decline from your $60 entry. That represents 12 and 5R if you had possessed the discipline to hold. Your smart trailing stop cost you over 11R of opportunity. You made $625 when you should have made over $6,000. Your risk management didn't protect you. It destroyed you. This scenario plays out thousands of times daily across every market in the world. Talented traders correctly identifying opportunities, entering at reasonable prices, then suffocating their own winners with emotional stop management. They're not wrong about market direction. They're wrong about their own psychology. Professionals use structure. not emotions, to ride trends. They build a phased protocol that removes discretion during the critical middle section of winning trades. Here's how it works in practice, step by systematic step. Phase 1 runs from entry 2R of profit. During this phase, your job is to do almost nothing. Your original stop stays exactly where you placed it, based on the pivotal point where your thesis would be invalidated. You don't tighten it. You don't move it to break even. You don't take partial profits to guarantee a winner. You watch and gather data. This is the validation phase where the market shows you whether your thesis has genuine merit. Amateurs cannot help themselves during this phase. They micromanage constantly, sliding stops tighter at the first hint of profit, taking partials just to feel good about booking something. But if the trade cannot produce 2R without dramatic whipsaws and constant retests of your stop, that's valuable information suggesting the trend lacks conviction. If price moves away from your entry cleanly, pulls back in orderly fashion without threatening your stop, then resumes the trend direction, that's confirmation. The market is behaving exactly how strong trends behave. Your job is not to interfere with that natural process. Phase 2 begins once you're up, 2R, and extends toward 5R. Now you make your first meaningful stop adjustment. You move your stop to break even, or to a small profit level, perhaps. 0.5R2. 1R in the green. This creates a critical psychological transformation. You've removed the risk of loss. Even if the trade reverses dramatically, you won't lose money. You're now playing with the market's money, not your fear money. This mental shift cannot be overstated in its importance. When you know you cannot lose on a trade, your emotional relationship to that position changes completely. You stop watching every tick with anxiety. You stop calculating how much you might give back if it reverses. You stop treating the position like a ticking time bomb that might explode. This emotional freedom allows you to hold through normal volatility that would have shaken you out if you were still risking your original capital. The amateur makes a fatal error here by moving to break even too early, often at plus 0.5R or plus 1R. They think they're being smart, but they're actually maximizing their chance of getting stopped out on normal noise before the real trend develops. The professional waits until 2R2, 3R before making this adjustment, giving the trade sufficient room to prove itself while still protecting against complete reversal. Phase 3 begins beyond 5R and continues until the trend breaks. This is where real wealth lives, and its territory most traders have already abandoned. Your stop management now shifts to trailing below structure, never arbitrary levels. You're not trailing based on percentages or dollar amounts that feel comfortable. You're trailing based on what the market is actually showing you. In a downtrend, you trail your stop above each new swing high that forms as the trend progresses. In an uptrend, you trail below each new swing low. You might use a moving average as your guide, perhaps a 20-period or 50-period moving average that captures the trend's natural rhythm without getting whipsawed by daily noise. You might employ volatility bands like average true range stops that expand and contract with actual price movement, not your emotional comfort zone. The governing principle. Your job is to stay in as long as the trend character remains intact, not until your P&L reaches some arbitrary number that feels big enough. The market doesn't care what feels big to you. It will trend as long as the underlying supply and demand dynamics support that trend. Your job is to ride it until those dynamics demonstrably change. Here's what that looks like in practice with our example. Your short position from 60 is now at 50. You're up 5R. You trail your stop to 54, just above the most recent swing high that formed during the downtrend. Price continues lower to 45. You trail to 49. Price drops to 40. You trail to 44. Each adjustment is based on structure, on where the market is actually showing potential reversal points, not on your emotional relationship to the profit number. Eventually, price bounces to 43.50 and stalls. You remain in the position because your stop hasn't been hit. It drops again to 37. You trail to 41. Finally, a sharp rally lifts price to 41.50 and breaks your trailing stop. You exit at 41, capturing $19 on A. $2 risk. That's 9.5 R. You didn't catch the absolute bottom at 35, but you captured the vast majority of the trend because you let structure, not fear, manage your exit. Now comes the advanced technique that separates legends from merely competent traders, pyramiding into strength. This concept terrifies amateurs because it seems like adding risk when you're already winning. But when executed correctly, it's actually the lowest risk method to dramatically amplify returns while maintaining strict risk control. Here's the precise framework. Your original position hits 3R. The stock breaks to new lows on expanding volume, showing renewed momentum in your favor. The trend is proving itself stronger than you initially anticipated. This is the exact moment to add a second position of equal or smaller size to your original. Simultaneously, your stop for the entire combined position moves to 1R profit on your original entry. Examine the mathematics carefully. If you get stopped out now, you still win. Your original position gives back 2R of its 3R gain, netting 1R profit. Your second position loses 1R. Total result, break even or small profit, depending on exact sizing. But if the trend continues, you now have double exposure to the remaining move. If the trend extends from 3R to 10R, you capture 7R on your original position and 7R on your pyramid edition, a total of 14R instead of 10R. You've increased your profit potential by 40% while actually improving your risk profile because your worst-case scenario is now break-even instead of a loss. This is asymmetric risk, taking at its mathematical finest. The amateur sees adding to winners as dangerous position sizing. The professional recognizes it as the only time adding positions makes logical sense, when the market is paying you to increase your exposure. The key maxim that must govern every decision in this phase: you don't exit because you're up a lot. You exit because the trend is over. Your P&L is completely irrelevant to the market's future behavior. Whether you're up 2R or 20R has zero impact on whether the trend will continue. The only question that matters is, has the character of the trend changed? Each new bar that prints, you ask yourself one diagnostic question. In a downtrend, are we still making lower highs and lower lows? Is volume confirming the trend direction on each new leg down? Are bounces orderly and shallow, or are they violent and deep? Is price respecting the structural levels that define the trend, or is it starting to violate them with conviction? Lower highs appearing in your downtrend, that's a trend signal worth respecting. Violent rejection against your position with massive reversal volume, that's a trend signal. A decisive break of a major swing level that has held multiple times, that's a trend signal. These are the market's messages telling you the underlying dynamics have shifted. These are legitimate reasons to exit. But being up 5R when you were hoping for 3R, that's not a trend signal. That's your emotional discomfort with success. Watching your unrealized profits swing from $3,000 to $2,400 on a normal pullback, that's not a trend signal. That's your inability to tolerate normal volatility. The professional learns to ignore P&L signals and respond exclusively to trend signals. This mental discipline, this aggressive patience, is what allows professionals to ride from 2R to 10R while amateurs exit at 1.5R, feeling proud of their discipline. Both traders identified the identical opportunity. Both entered at similar prices with comparable risk. But one captured 15% of the available move while the other captured 85%. The difference wasn't analytical skill or market timing. It was emotional endurance guided by structural rules instead of feelings. In our final chapter, we confront the ultimate challenge in this entire process: the psychological warfare of sitting still while your unrealized profits swing violently. Because everything we've discussed, risk management, pivotal points, phase stop management, pyramiding, becomes meaningless if you cannot execute the hardest skill in trading. The skill of doing nothing while the market does everything. The skill of letting time and trend do the work while you simply observe and wait. This is where most traders fail, not because they lack knowledge, but because they lack the emotional fortitude to sit tight when they're right. The hardest part of catching a 110 trade isn't the buying or the selling, it's the sitting. It's the excruciating psychological endurance required to hold a position while your unrealized profits swing violently, while every instinct screams at you to do something, while the voice in your head whispers that you're being reckless with real money. Getting in is mechanical. Any trader can press a buy button when they see a breakout. Getting out is emotional, but quick. Fear or greed will make that decision in seconds. But everything that happens in between, the waiting, the second guessing, the boredom, the temptation to interfere, that's where fortunes are made and destroyed. Amateurs think trading is action. They believe trading is clicking buttons, analyzing charts, drawing lines, reading news, moving stops, taking partials. They equate activity with productivity because that's how the rest of life works. More hours at the job means more pay. More practice means better skills. More effort produces better results. But trading inverts this relationship completely. More activity usually produces worse results. The trader who makes 50 trades per month typically underperforms the trader who makes 5 carefully selected trades. Yet the 50-trade trader feels productive, while the 5-trade trader feels lazy, even though the lazy one is building wealth. Professionals know that trading is mostly waiting. It's the art of aggressive patience. It's doing nothing while positioned correctly, letting time and trend compound your edge while inferior traders panic around you. It's waiting with conviction until the trend itself tells you it's finished. Jesse Livermore understood this at a level that still cuts through market noise a century later. His most famous quote should be carved into every trader's screen. "It never was my thinking that made the big money for me. It always was my sitting." Read that again slowly. The man who turned thousands into millions, who made and lost multiple fortunes, who understood market psychology better than almost anyone in history, he didn't attribute his success to brilliant analysis or perfect timing. He attributed it to sitting still, to doing nothing while positioned correctly, to letting time and trend do the heavy lifting while he simply observed and protected his position. Livermore didn't trade every day. He didn't chase every setup that looked promising. He didn't feel compelled to have an opinion on every market movement or maintain constant exposure. He waited like a predator for the market to offer him high-probability situations where all factors aligned: trend, volume, sentiment, timing, structure. Then, once positioned near these pivotal points, he sat in that position while the trend unfolded. He might hold for weeks, months, occasionally over a year. While other traders churned their accounts trying to capture every wiggle, Livermore sat and accumulated wealth. He would go weeks, sometimes months, without a significant position. He called this sitting tight, even when he wasn't in the market. He understood something that destroys most traders: you don't get paid for effort in this business. You get paid for being right, and staying right. You get paid for recognizing when the market is offering you nothing worth betting on, and having the discipline to wait until it does. Most traders are psychologically incapable of this productive stillness. They need to feel busy. They need to feel like they're working, because they're addicted to the dopamine hit of the click. They mistake motion for progress. So they overtrade, entering marginal setups just to have something to manage. They exit winners early to book profits and feel the validation of being right. They enter new positions before the old one finishes developing, unable to let one opportunity fully mature before chasing the next. They slowly kill their equity, trade by trade, mistaking activity for achievement. Let me show you the exact scenario that destroys more trading careers than any single mistake, because you've lived some version of this and you need to recognize it before it happens again. You've just executed perfectly. You caught a genuine 1008 trade. You risked $500 according to your 1% rule, and you're now sitting on $4,000 of realized profit. If your account is $50,000, this represents an 8% gain from one position. This should be a career-defining moment. You should be studying what you did right so you can repeat it. You should be protecting this win by waiting patiently for the next A-plus setup. But the amateur brain doesn't work that way. The adrenaline is flooding your system. The chemicals in your brain are surging. You feel invincible, like you've cracked the market's code and now everything will work. The voice in your head becomes intoxicating. If I can make $4,000 on one trade, Imagine if I catch another one right now. I could make 8,000 this week. I'm in the zone. I see the matrix. I need to capitalize on this momentum. So you immediately start hunting for the next trade. You scan your watch list with urgency. You want to repeat the feeling, capture the high, prove to yourself and others that it wasn't luck. You find something that looks vaguely promising, a stock that's been choppy, but just broke above a minor resistance level. The volume is mediocre. The trend isn't clear. There's no obvious pivotal point. The setup is a C+ at best, maybe a D+. But you're high on your recent win, and you talk yourself into it. It could work. The market feels strong. I'll just risk the same. 500 and see what happens. You enter the position. Over the next 2 days, that choppy stock whipsaws violently. It gaps down on no news, rallies intraday on short covering, then collapses into the close on renewed selling. Your stop gets hit for a full 1-hour loss. But you're not done torturing yourself. The stock bounces the next morning and you think, maybe I was just early. You re-enter on what looks like a recovery. That fails too as the stock rolls over again. Another 1-hour loss. In 48 hours of frantic activity, you've given back $1,000, 25% of your hard-earned, $4,000 win. The trade that should have been a career highlight now feels diminished, tainted by your inability to simply stop and protect it. You turned a life-changing week into a mediocre one because you couldn't switch from attack mode to wait mode. You couldn't sit tight after being right. The professional does the exact opposite. After that, 1/8 winner, they do nothing. Absolutely nothing. They don't hunt for the next trade. They don't force setups that aren't there. They wait. They watch the market with complete detachment, knowing that another A+ setup will eventually appear, but it might take days or weeks to develop properly. After a big win, the professional understands their emotional state is compromised. They're overconfident, impulsive, less risk-averse than normal. They're exactly the wrong psychological state to make sound trading decisions. So they implement a simple but powerful rule after any trade that exceeds 5R. They take a minimum 1-day break before entering another position. This cooling-off period allows emotions to normalize and prevents the euphoric overtrading that kills so many winning streaks. Their job after a monster winner isn't to multiply the profit immediately. Their job is to protect that profit by refusing to give it back through low-quality trades driven by adrenaline rather than analysis. They understand that you don't need to trade again today. You don't need to trade again this week. You need to wait for the next setup that meets every single criterion of your system. This is where you must internalize a truth that feels wrong at first. Cash is a position. Waiting is a position. Doing nothing is often the most profitable thing you can do. When you have no edge, any trade you take is negative expectancy by definition. In that context, holding cash is mathematically superior to trading for the sake of activity. When you're in cash, you're safe, you're objective. You're ready to strike with full force when the perfect opportunity aligns. When you're in a mediocre trade just to feel busy, you're exposed, stressed, and unavailable for the real opportunity when it finally arrives. The market rewards patience with fortune. It punishes impatience with poverty. Every forced trade, every marginal setup you enter out of boredom, every winner you exit early because you can't stand the emotional discomfort. These are all forms of impatience, and they all cost you money. Here's the mathematical truth that takes years to accept. You don't need to trade frequently to build extraordinary wealth. You need to trade correctly when genuine opportunities appear. 3. 110 trades per year will change your life forever. That's one trade every 4 months. If you risk 1% per trade and catch 3. 110 winners, that's 30% in gross profits. Add in your inevitable small losses and break-even trades throughout the year, and you're still likely up 25% annually. That kind of performance, compounded over a decade, builds generational wealth. But most traders can't accept this timeline. They want 20% this month, not this year. So they trade 50 times trying to capture what 3 patient trades would have delivered more reliably. They mistake frequency for profitability and wonder why they stay stuck at the same account level for years. Let me give you the complete protocol for catching. 110 trades, integrating everything we've built across this entire system. This is your blueprint, your systematic approach to turning good trades into career-changing trades. First, risk. 0.52. 1% of equity per trade to survive the losing streaks that inevitably precede monster winners. This isn't conservative position sizing. It's the only structure that allows you to keep pulling the trigger when you're down. 7% after 7 consecutive losses, and the 8th setup appears. That 8th setup might be your 110 trade, but you'll never know if you've already blown up your account and your confidence by risking. 3% per trade. Second, enter only at pivotal points where your thesis can be clearly proven wrong. Your stop isn't placed where you feel comfortable losing money. It's placed where the market structure says your idea is invalidated. This precision allows tight stops, clean risk definition, and the asymmetric setups where 1R of risk can become 10R of reward. Arbitrary stops placed for emotional comfort guarantee you'll get shaken out of every genuine trend before it pays. Third, use phase stop management to ride trends without self-sabotage. From entry 2. 2R, do almost nothing. Let the trade validate itself without interference. From 2R2. 5R, move your stop to break even to remove loss risk and shift your psychology from fear-based to patience-based. Beyond 5R, trail stops below structure using swing points, moving averages, or volatility bands, never arbitrary percentages or dollar amounts. Your job is to stay in as long as the trend character remains intact, not until your P&L reaches some number that feels enough. Fourth, pyramid into strength, never weakness. When your original position hits, 3R and the market shows renewed momentum in your favor with volume confirmation, add a second position while moving your combined stop 2. 1R profit on the original entry. This amplifies your exposure to genuine trends while protecting you from reversals. You're using the market's money to increase position size at exactly the moment when probability is highest, when the trend is proving itself stronger than you initially anticipated. Fifth, exit on trend breakdown, not profit targets. The market doesn't care that you're up. 5R or 10R. It will trend as long as underlying supply and demand dynamics support that direction. Your job is to ride it until those dynamics demonstrably change, lower highs appearing in an uptrend, violent rejection against your position with massive reversal volume, decisive breaks of major swing levels that have held multiple times. These are trend signals that deserve respect. Your P&L size is not a trend signal. It's an emotional signal, and emotions are the worst possible guide for exit timing. Sixth, and perhaps most crucial, wait between setups. Patience protects everything you've built. After a big winner, resist the urge to immediately find the next trade. After a string of losses, resist the urge to force a trade to get back to even. Let the market come to you on its terms, not yours. The best traders spend significantly more time waiting than trading, and that's precisely why they're the best. The amateur looks at a 110 trade and sees luck, a random gift from the market gods that occasionally falls into the lap of fortunate traders. They think, wow, he got in at the bottom and out at the top. What incredible timing. What a gamble that paid off. The professional looks at the same 110 trade and sees the inevitable result of discipline applied consistently over time. They see the 7 small losses that were taken without complaint. They see the weeks of waiting for the perfect setup to align. They see the agony of sitting through normal pullbacks without clicking the sell button. They see the systematic process that made the extraordinary result mathematically probable. This isn't just about trading mechanics. It's about character transformation. It's about mastering the impulse to act when inaction is the superior strategy. It's about developing the emotional fortitude to sit still while unrealized profits swing wildly, while friends question your sanity, while every instinct screams for action. The market will offer you enough, 110 opportunities every year to build substantial wealth, but only if you're positioned correctly when they arrive and disciplined enough to ride them when you catch them. You now possess the complete architecture for catching. 110 trades. The question isn't whether you understand the protocol. You do. The mechanics are simple. The execution is excruciatingly difficult, because it requires you to fight your own biology, your need for validation, your addiction to activity. The real question is, will you sit tight when you're right, or will you kill your elephant early because you can't tolerate the discomfort of watching unrealized profits swing? Will you wait weeks for the perfect setup, or will you force marginal trades because you need to feel like a trader? Will you protect your big wins through patient discipline, or will you immediately give them back through euphoric overtrading? Stop trying to get rich on Tuesday. Stop trying to double your account this month. Start trying to get rich over the cycle, over years of applying the same calm, ruthless discipline. 1. 110 trade won't make your career if you give it back on the next 5 trades, but a series of well-managed 110 trades, protected by aggressive patience between them, will change everything. The trend is your friend, but patience, disciplined, unwavering, aggressive patience, is your fortune. Cut losses fast when the market proves you wrong. Size small so you can survive the inevitable losing streaks. Wait longer than feels comfortable for setups that meet all your criteria. And when you're right, sit tight. Let time and trend do the heavy lifting while you simply observe and protect your position. This is how professionals turn good trades into career-changing trades. This is how you catch 110 moves while others are celebrating their 1001.5 winners and wondering why they never get ahead. The protocol is elegant in its simplicity. The execution demands everything you have. But the rewards for those who master both are extraordinary. The next lesson on building a systematic trading process will show you how to make these rules automatic, so discipline becomes habit rather than willpower. Because knowing what to do is the easy part. Doing it consistently when your emotions scream otherwise, when you're bored, when you're excited, when you're scared, when you're overconfident. That's the real work. That's the edge. That's the difference between trading for 20 years and having generational wealth to show for it versus trading for 20 years and still struggling to stay break-even. The knowledge is now yours. The question is whether you have the character to apply it when it matters most.